In this episode, once again, we speak to the amazing Jonathan Blau. Jonathan is the founder and the CEO of Fusion Family Wealth, a Long Island-based fee-only registered investment advisory firm. His investment philosophy is centered on helping shape positive money behavior and by teaching wealthy people to consistently make rational financial decisions under uncertainty. Jonathan and his team at Fusion Family Wealth oversee approximately 1.1 billion in assets under advisement and management. He believes that investor temperament, what one does, as opposed to intellect, what one knows, is the dominant variable determining investor success or failure. As such, Jonathan focuses predominantly on conditioning investors to learn to ignore current events and always act on their plan and never react to the market and media. And today we're speaking to Jonathan about why entrepreneurs tend to make poor investors. Let's find out. And remember, if you want to upgrade your money mindset, then click on the link www.millionairefoundations.com and watch my free training. Welcome. This is Gull, your money mindset expert. And once again, we have the wonderful Jonathan Blau. Welcome, Jonathan.
Thank you very much, Gull. Again, a pleasure to be here as a guest on your podcast.
Thank you so much for coming back, Jonathan. We had such a fantastic conversation on Friday Feature. We have to continue that today. So we had to have you back. Now, Jonathan, once again, everyone's heard your intro and they know how fabulous you are, but please, in your own words, tell everybody what it is that you do.
Sure. Okay, thank you. What we do is we help people who have the responsibility of managing wealth to learn how to make rational money decisions when they're faced with uncertainty. And we do that by helping them address the many biases that are built into us as human nature has it, that drive poor decision making. And then we, based on that, help them modify their behaviors so that their outcomes have a higher probability of being successful.
Wonderful. So that leads us on today's episode, which is why entrepreneurs can be poor investors. Now, this really hit home the title for myself because I'm a fabulous, I will even introduce it myself. I'm a fabulous entrepreneur. I have multiple businesses and I have successes and failures, of course, all of them. But as an investor, oh my God, I can be a really rubbish investor. So that's why I thought that was a perfect title for today's episode, because a lot of the people listening to this podcast are entrepreneurs or want to be entrepreneurs. So tell us, Jonathan, why have you singled out entrepreneurs who, not all entrepreneurs, but vast majority of them, myself included, have a tendency to become poor investors, even though we're quite intelligent and are very successful with running businesses?
So that's a great segue, but because I am also an entrepreneur, as you are, and I'm prone to the same mistakes. So even though I can help people, it's often the cobbler's kids have no shoes. I've been prone to make a few mistakes financially myself over the years because I don't have the benefit of myself advising me.
Exactly. Yeah.
Against them. But yes, so entrepreneurs, the way we got rich as entrepreneurs doesn't give us the skill set to stay and get rich as investors. And in fact, oftentimes, for example, an entrepreneur usually needs as one of their skills the ability to not be afraid of taking risks and big risks and concentrated risks and doing them again and again. And looking to build up the value of whatever we're trying to create quickly and then replicate it, believing that we can replicate it because we did it the first time. When it comes to investing for the long term, the skill set that someone needs is patience and discipline, the ability to diversify and accept that the goal is not to find what is going to be the best returning thing I can put my money into over the next 2 or 3 years, but what will be the thing that I can invest in with an average return that I can stay with for the longest period. That's compounding. And that's what's important with investing. So I always like to say investing is compounding is taking my return 7 or 8% to the power of time. So time should be doing all the heavy lifting, not figuring out what I can do the most with for the next 2 or 3 years. And in fact, if someone said to me, what's an entrepreneur or anybody, what are the most important things I can do, Jonathan, if I wanted to increase my chances of maximizing the wealth I've made from my business as an investor? I'd say two things. One is save as much as early as possible toward that goal. And two is, and this is more important, extend your time horizon. Those are the two things. That's not what most people would expect to hear. Most people expect to hear you've got to get educated and read all kinds of investment books and find the economists who can forecast the economy consistently, so you'll know when to get in and out of the markets and so forth. Those are the things that kill investing success, not lead to it.
I mean, everything you just said really came home for me, because I think this is a conversation we had off camera, is the skills that make you a great entrepreneur, which is your ability to your appetite for risk, your appetite for seeing through the fog, and being overly optimistic. I think you have to be overly optimistic to be a successful entrepreneur. You have to see things that other people cannot see, and these skills help you as an entrepreneur, because you have to have the faith. You're a leader, especially if you're on business. You are the leader. People have to follow you, and you have to have that faith. But when that seeps into investments, and you have this overly positive expectation from an investment that may not come to fruition, as I've found many times the wrong way. It went the wrong way. I wasn't expecting it. I was like, no, this is a guaranteed thing. This is a guaranteed returns. There's guaranteed returns. There is no possibility of loss. And I remember saying that, and within a couple of months, it was just shambles. So
that's right. So what happened to you is what happens to a lot of us entrepreneurs. We become, as a result of our success as entrepreneurs, overconfident.
Yeah.
We have what's called that's one of the biases, overconfidence bias. So as entrepreneurs, we're human beings like everybody else. We have all of the many biases. I may discuss a few with you as we go on into the podcast, but all of those biases we all have, the entrepreneur then has this big magnifying glass called overconfidence that makes those biases even more harmful to the entrepreneur than to everybody else.
Yeah.
And so I like to say the entrepreneur tends to not only need this kind of counseling from me or somebody, but they need it usually more than others, because they make the same mistakes as the rest of us, but with a lot more confidence and a boatload more money. And so they'll benefit more from this advice than most others.
Yeah, I think that's the biggest thing. You do it a lot more quickly and a lot more with a lot more money. So you lose both things with your time and your money. So so let's talk about the biases then. So what kind of biases do people have when they come to you with this large pot of money?
So typically all of us tend to have what's called loss aversion bias. So there was an economist, Richard Thaler, who won the Nobel Prize for showing that the pain of a loss to us, financially or otherwise, is felt 2 times greater than is the pleasure of a gain felt pleasurable. So because of that, we're much more sensitive to losses. Then when you factor into that, another thing that I've learned is we're much more sensitive in general to changes in the value of what we own than into the absolute level of wealth that we have or the value itself. So changes are much more important. So when you factor in our fear of loss with our adversity to seeing things change, that leads us to make very poor decisions for the long term, which is we need to invest in things that can grow our wealth past inflation, well past inflation, which is investing as owners, generally in companies, as we call stocks. And most of us, though, because of those two biases, loss aversion and the sensitivity to changes in the value, we tend to want to invest in things that minimize short-term loss and short-term fluctuation, which are things like bonds. Those are also the things that minimize the ability to grow our wealth past inflation, to protect the purchasing power of all our dollars. And so we need to reconcile those two beliefs. And so one of the things I'll talk about, Gull, is we have, as it relates to that, a flawed system of beliefs and behaviors that lead to some of these biases. So one of the beliefs in our belief system is if I held up $100 bill and I asked an audience, as I do this for accounting firms as continuing education, in one word, what do I hold up? 99% of them will say money. The problem is it's not money, it's a currency unit. It's probably a peerless medium of exchange, so that if I sell oranges for a living, I don't have to go to the Tesla dealer and say, how many oranges do you need for the Tesla? That currency unit, the $100 bill, and a number of them will get that exchange accomplished much more easily and uniformly. So now, by not understanding that that's a currency unit and not money, I define money as purchasing power. Currency doesn't store value. As investors, entrepreneurs, and otherwise, we actually think as long as I perfectly preserve this 50 million that I just sold my business for, that's the most important thing. I can't afford to lose any of it. And in 30 years, if they still have just the 50 million because they kept rolling it over in a bond and it never went past 50 million, granted they got interest every year, but the principal was frozen. Now it's only worth about 45 million. And so they've lost, but in the safest way possible, because it didn't fluctuate, over half of their purchasing power, or what I call money. So the first flawed belief is that money and currency are the same thing. And that means that we think if we just preserve our dollars, the currency, that we preserved our money, our purchasing power. We haven't. The second flawed belief is that risk means volatility. That risk and safety should be measured in terms of protecting the number of dollars we have from fluctuating, instead of what it really needs to do is protect the purchasing power or the value of each dollar from eroding, right, to inflation. And so by having those two flawed beliefs, we take advice from an industry, general advice, that tells us to protect the money from fluctuating. That's our big risk. And as we get older, we should really protect those fluctuations more.
Even more
bonds,
so, So
right?
the older you are, the less risk you should take. Yes, that's
and in
what I've
fact,
heard.
what they're doing is they're pouring on every one of us more risk by telling us to avoid what I call the fake risk, which is volatility. The real risk is the erosion of purchasing power more and more as you get older. And when we retire today in our 60s, joint life expectancy is close to 30 years. It's even more of a, so the cancer of money is inflation. People think that the cure is bonds. Bonds are the carrier. Stocks are the cure. So that's the first two things, those two beliefs. Money and currency are different, and risk and safety need to be measured not in terms of volatility and protecting principal, but protecting purchasing power. Then there's flawed behaviors. So there's three behaviors. One is actually physical, which you're familiar with. It's the amygdala, or the fear sensor, these two walnut-shaped organs at the bottom of our brain, designed to protect us from life and death threats. Well, unfortunately, they don't know the difference between a life and death threat and the stock market going down 30%. So the bells go off, and all of a sudden, we're doing the opposite, human nature-wise, what we need to do. We're selling when we should be buying more, or holding the course. The second thing
is discounts. I always say, I mean, when I see things go down, I'm like, oh, look, things are on discount. You've got 30% off.
Right?
Yeah, they're on sale.
So that's a good lead into one of the second flawed behaviors that we have. And this one always fascinates me. It's I call it cultural. So we're generally, when it comes to responding economically to opportunities, we're generally behaving in a way that's called counter-cyclically. So meaning our demand is counter to the price. We're attracted, our demand goes up when prices go on sale, and our demand goes down when prices rise. We're repelled by higher prices, attracted to lower prices. We behave that way with almost every financial and economic input except one: the price of stocks. When the price of stocks is high and rising, like it was in the late 90s,
it's the FOMO. You want more. Oh, no,
that's right. Human nature somehow thought the risk of buying at these higher prices is declining, and my claim on these companies' future earnings and assets at these higher prices are going to yield me a higher return. And when prices of companies are falling, human nature thinks that the value, the long-term enduring value, has also fallen, and that the risk of buying at these lower prices has increased, and the claim on the future assets and earnings paying lower prices is somehow going to be lower. And so what I teach people is reality isn't different than what human nature thinks. It's the opposite. So that's the economic conundrum, right? That we all, and we can all relate to that, because it is, if we're all honest, we could say, yeah, when I invest, I don't behave the way I do economically with everything else, right? So imagine if there were tuna fish was on sale in your local supermarket. Normally it's 3 cans for $5. And then next week, you go in and it says manager special, 3 cans for $10. We don't say, oh, I better buy the heck out of this stuff because it looks like there's a bull market in tuna. Right? We don't do that. We don't load up the truck, right? But that's how we behave with investing. And then the second part, so we did the physical, which is the amygdala, physical
Yeah.
response, can't control. We did the economic. The second is the emotional or psychological. So when we talked about already loss aversion bias, the
Yeah.
pain of a loss, but there's something else. So think about this. I had a client that came in a number of years ago whose grandfather left him an inheritance, and he was 52, the person, and he was the only inheritor, and it was 5 million, and it was all in one company. It was Merck, the American drug company, Merck stock, and it was $5 million. So the person said to me, my lawyer referred me to you. Can you help me with a plan? And so we talked about a plan, and he wanted to buy a home. So we said, okay, of the 5 million, you can take 600,000 and buy the home and stay within your budget that you want to spend 200 a year and never run out of money. And so he said, okay, great. What are the next steps? So next step is we have to sell the Merck stock. He pushed his seat back. So what do you mean sell the Merck stock? So we had two problems. One is something called regret aversion. It's very powerful. When we have the fear that a decision we'll make will lead to regret, we go to status quo bias. Just leave it the way it is so I can't regret it. So he said to his mind, I'm just leaving the Merck. What if I do something? My grandfather, and the grandfather bought Merck because he was a pharmacist, and we have familiarity bias. We like to buy things and invest in things we know, irrationally thinking they'll help us more and hurt us less. Something. No. In this case, luckily, the grandfather's portfolio didn't blow up because of that. So now the second part of this, aside from regret aversion causing him to want to keep the Merck, was much more fascinating. Something called the endowment bias. We actually value things that we own and could lose differently than the same exact thing that we have the opportunity to gain. So the best example I give is a home. We all have homes, right? Everyone kind of owns a home. So if I said, if you said you had a home and let's say it's worth $1 million and you were looking to sell it, and the agent from the home agency that you're looking to hire tells you comparable sales in the neighborhood are $1.2 million to $1.3 million, how much would you ask for that house if you put it up for sale?
Yeah, something along the line, 1 million, 2 million, 3, yeah.
Right. If you were bidding on the house, how much would you bid?
I will try to get for the lowest price possible.
Right. So you just valued the same asset. This works in everything differently than whether you owned it versus you had the opportunity to buy it. And that's what he was doing. So the way you break through it, as I said to him, if grandpa left you 5 million in cash instead of Merck stock, and at the end of our meeting, when you questioned me as to what are the next steps, I said, we're going out in the morning and we're putting all this 5 million in Merck stock. What would you say? He said, I'd push back and run out of your office. I said, but that's what you're looking to do by telling me you want to hold the Merck stock, right? Same decision. So we broke through it by understanding he had the endowment bias and how to address it. And so that's just a couple of examples of some of the psychological biases that we all have. So the entrepreneurs have these same biases, but again, they're magnified because of overconfidence. Overconfidence is funny. If you asked a room full of drivers, how many of you consider yourself above average? Almost everyone's going to raise their hand, but by definition, only half of them can be above average drivers. And it will work the same way with a room of entrepreneurs. They're all better than average business people and investors if you ask them and so forth.
I mean, I think that that's a fair comment to make, because we all have this idea that if you don't believe in it as an entrepreneur, if you don't believe in yourself, you cannot succeed. It's simple as that, because no one can see your vision until it comes to fruition. So you have to have this vision, you have to have this belief in yourself, and only once it becomes a reality that people can see it, and then they start, forming, coming behind you and they say, oh, congratulations, or they give you all sorts of stuff. Without it, people look upon you as a mad person. I know myself, within my circle, within my family, I'm the weird one. I'm the clown. I'm the one who's got all these funny ideas, and I do all sorts of funny stuff. And I'm a lawyer, but I'm doing all these other, crazy stuff. And I'm the mad woman. But when things work out, then oh, but you're so smart and you're so this, and I'm like, okay, I wasn't smart 2 years ago.
That's right. That's right.
But it's one of those things. But then that attitude, that thick skin, that sort of foresight, that sort of vision helped me in my business endeavors, all various ones, or learn from them. Some of them did work out, of course, and you learn from it. That same head, I was say, being stubborn or strong-headed does not necessarily work in the investment arena.
Well, and what's also, there's another bias that addresses that. There's
Mm,
many, but one is
mm,
called the outcome bias. We
yeah,
don't judge what our actions should have been based on the prudency of the input. I should
yeah,
have done this, I
yeah,
did this, but the outcome doesn't reflect what I hope. So
yeah.
based on judging it just on the outcome, we said what I did was no good. So an example I always gave, and we said I have two young children. So when they were 17 and 18, they said, Dad, we're going to a party and we're going to drink. I
Mm,
said, fine, just come home with someone who didn't drink. So they come home with someone who didn't drink, and their friends went home with someone who did drink.
mm.
My daughters, with the person who didn't drink, got into a fender bender, and they ended up with a broken arm and a broken wrist in the hospital. When I went to visit them, they said, see, Dad, if you wouldn't have given us that bad advice and tell us to go home with someone who didn't drink, we would have gotten home without event, because the guy who drank took the kids home and they didn't have an accident, right? So the question is, the outcome bias causes us to make those crazy decisions, and entrepreneurs are more prone to that probably than most of us, because the outcome of their success, their big bet, was so positive that they now expect the outcome of everything they're going to do
To be
to reflect
positive.
that same
Yeah.
positive result.
And this happens regardless, even if you've had multiple. I mean, I don't know any entrepreneur who hasn't had failures. It's just not possible.
We
And
have
they've had
failures, right?
multiple failures. But you seem to somehow dismiss those. I mean, I learn from my failures, and I do try to learn from my failures. But I feel that a lot of the times I'm too quick to dismiss it. I'm like, okay, let me focus on the positives. Let me focus on how to move forward. And that works in the business arena. That works in as an entrepreneur. That doesn't work for investments, because you cannot so quickly brush something under the carpet and next and move on. You have to understand why you made the decision, why it led you to the downfall. And there's something that I learned from one of my mentors in the world of investing. He said, as an entrepreneur, you need to make quick decisions. You need to, make how can you make more money? How can you expand your income? But as an investor, you need to be slow to invest and work out, okay, how do I protect this? How do I make this decision? How can I make sure that I'm not, running away with things? He says, be quick to make money, be slow to invest. Not, he said, invest. Of course, you have to do it from day one, but don't invest the way you sort of make your business decisions. You should be the
That's
opposite
right. Well,
sides.
think about it. Think, as all of us entrepreneurs, what are we looking for? We're looking at our company. We have a couple of bad quarters. We have divisions. Well, what
Yeah.
do we want to do? We want to get rid of the bad divisions, right? We want to go, let's jettison the bad divisions. When you're looking at a diversified portfolio, to the economic point I made,
Mm-hmm.
when one of the components is on sale, we look at it as a bad division. Let's get rid of it, right?
Yeah.
And then we don't, when we should be buying more of it, right? So two different things are happening, but we're playing two different games, but we just don't realize it,
Yeah.
because as an entrepreneur, that's what led us to success. And again, our overconfidence is, no, when there's something, a bad component, you got to get rid of it. But that's the opposite of what you want to do. So again, as entrepreneurs, we're programmed to succeed in ways that we need to often do the opposite to be programmed to succeed. Compounding as an investor at the best rate we can stay with for the longest is very different than keeping the business components that have the highest returns for the next few years so I can flip it. Very
Exactly.
different,
Yeah.
very different outlook.
I mean, when you were talking, I was thinking about cryptocurrencies, and that we're going through a cryptocurrency winter at the moment. So Bitcoin's come back up, but that's
I
another
say it's
thing.
warming up, right?
Yeah. So that's, I mean, it's doubled. I mean, it dipped to about 16,000 just a few months ago, and then now it's doubling. It's more than doubled. It's sitting at 37,000 the last time I checked. So it's done pretty well. And so I think that's something else. A lot of people have these, all these new investments that come up. And so, oh my God, I'm the FOMO around it, or Dogecoin, and there should be new, these overnight millionaires or billionaires,
That's
or
right.
whatever have you. And I think there's a lot of FOMO that's created around the area of investment. I think cryptocurrencies are great. I have lost some money in terms of some of the coins. I was one of the people who had money in one of the major, I won't say the name, that actually collapsed, and which was quite surprising. They did, but it did. But I lost a few thousand on that, not hundreds of thousands, but a few thousand on that. But it's overall, it's it's an investment that you do long term with a small amount. Now, do have a diversified portfolio. Again, learned through the hard way.
That's good.
My cryptocurrency is a small portion of the rest of my portfolio. So even though at the moment I would say it's negative of, it's showing me that, oh, you're minus blah, blah, blah. I know that eventually when it goes back into the booming time of cryptocurrency, which will probably in the next couple of years, so I'll be back in the green. I'll be fine, and end up getting money. But I'm able to see that clearly now. Had I not gone through that learning curve that I did 5-6 years ago when I lost a lot of money, that's when I would have, because a lot of people, when I just sat pretty and I just thought, okay, let's go through the crypto window. A lot of people came out. So they bought really high prices. And when it became low, they were all selling. And I thought, why? Okay, some of the smaller coins, altcoins you don't know about, you can sell, but the larger ones, that
it's because of what I talked to you about.
Yeah.
It's human nature, right? That's it. I summarize that by saying from investing, I look at Bitcoin and things like that as speculating, not investing.
Okay.
Because they don't have a reliable income stream that they produce and things like that. To me, an
That's true. That's true. Yeah, that's a good distinction to have, actually, because you don't know what kind of reliable income streams you can
how do you
have
value? So if you don't know how to value something, it's hard to call investment. But I don't say there's anything wrong with it. I always say from a behavioral standpoint, I like people to carve out a piece if they like to do that, because that helps them give me the piece that needs to be protected and not interfered with, right? To help them make sure they hit their goals. But what ends up happening is when we lose sight of the game we're playing. So in other words, everyone's called an investor. But if I'm a long-term investor, I shouldn't be selling out in panic because of a 5 or 6% decline in a day. But if I'm a professional trader, it's my mandate to sell out in the face of a 5% decline. We're both called investors, but we're playing different games. And a lot of the reasons bubbles get created is in the late 90s, long-term investors were looking at day traders who were buying Cisco systems or Lucent Technologies or AOL at the beginning of the morning and looking to get out by the end of the day. And suddenly, as those things were skyrocketing into a bubble, I believe it happened because a lot of the people who were playing the long game forgot the game they're playing. They started playing the day trader game, not realizing it. Those people are out at the end of the day. You're taking your long money and inflating the bubble. And so by not understanding the game we're playing, by not recognizing everybody's goals and objectives are different, and not understanding that the person who's telling you how much money they made in X is not playing your game. Different risk profiles, different needs, different understandings. We get caught up. And so it's always important to focus on what are our needs. Anybody that I've ever met who makes 7 or 8% a year in a diversified portfolio, compounding with dividends growing in the S&P at about twice inflation, has more money than most people that they ever met, doing a lot of the other things in and out and speculating and trying to find out what's the next nanotechnology investment that's going to make them the most money. And that's hard. Warren Buffett was asked by Jeff Bezos, Warren, you never really had a real business. How did you get so wealthy just from investing? And Buffett's answer was kind of simple. He said, you know what I did? I made money slowly. Nobody likes to make money slowly.
Yeah. I mean, he had compounding and time on his hand.
That's what it is.
That's what he did. That's basically it was.
I think
it's very
90%
boring.
of his money was made from what I read after the age of 65.
Yeah, 55 or 65, one of those
65,
two.
Yeah. It's either 90% or 95%, but after the age of 65.
It's just compounding at its best. But he started early. That's the beauty of it.
Remember what I said? If someone said, what are the 2 things I could do to increase my chances of having the best wealth outcome from investing? Start early and increase your time horizon. That's it.
100%. Okay, so I think we've discussed this in detail. Let's wrap this up. What advice would you give to entrepreneurs who are thinking about investing or who are currently investing and who are scratching their heads thinking, and this would be a common thing, by the way, so I really want to address this because I had this in the past. So I'm so smart, I can do so many things. Why am I such a shitty, excuse the language, why am I so rubbish at investing? Why? I'm sure I'm so, I am so smart. I can do so many different things, and I made all these things, and for some reason when it comes to investing, I am really poor. And I love what you said to me. I don't know if it's off camera or on camera. Somebody who's smart is going to be worse off investing than somebody who has less knowledge. So I have my cousin who is a housewife, and she invests in property and she invests in gold. That's the 2 things that she does. She doesn't do anything else. And till this day, she's never lost out money at all in anything.
Well, think about this, right? So this goes back to how we measure loss. Measure loss in terms of fluctuation of the value of what we have. Think about this. In 1980, gold had peaked at about 800 an ounce. That was at the bubble level where in the U.S. interest rates had to go to 20% to break the back of inflation. Gold was 800. Today it's under 2,000. So it's grown about 2.5 times. Inflation since then has grown dramatically more. And the stock market, the S&P was 100 then. Today it's 4,300. So $1 million in gold is 2.5 million. $1 million in stocks is 43 million. So your cousin has lost a tremendous amount of purchasing power, money. She just doesn't define it that way, right? So that's a perfect real life example. But to your point, so entrepreneurs in terms of why is it that they invest like rubbish, to use I'll use your second term, not the first term. Although I like the first term, I just don't know what's appropriate. So so the reason is that investing successfully is one part intellect, what we know, and those guys and women who are entrepreneurs think they know a lot more than we all know.
Yes, 100%.
A lot, right? And number two, it's 1% what we know or intellect. It's 99% what we do or temperament. And so because entrepreneurs think they know a lot more than they know, and that it's translatable to anything they do to lead to success, and because their temperament is such that they're overconfident and can't control their action, their instinct of what they want to do, even though it's against maybe for investing what they should do. Those two things work together, believing that what they know and how much they know will be successful elements of investing, and then not understanding that their overconfidence will cause them to over-concentrate and not stay with their investments for the long haul the way they need to compound. That's the reason that entrepreneurs, those two reasons are key reasons entrepreneurs tend not to be good investors.
That's a great answer. So I'm not saying that this puts entrepreneurs off the hook, but at least it gives you an understanding as the individuals and those who are listening to us, especially me, in terms of why I made the mistakes that I made and why am I good at business, but not necessarily investing, even though I'm good at maths, I'm good at numbers, and I'm good with business.
That's right.
Yeah, but it doesn't necessarily translate into being a good investor, especially when money is involved and it's your money.
That's right. And there are, we can't reconcile those things oftentimes, right? We can't accept the fact that I'm so smart and I know so much. But the other thing that I'll point out for entrepreneurs is, without us meaning to be, we tend to be selfish. So I coined a phrase that I have to figure out how to try to get into the behavioral finance vernacular, but I call it the illusion of predictive value. And entrepreneurs suffer from that illusion. I've seen more than most of us, and we all do. So you ever hear someone say, I'm investing in this because I think XYZ is going to happen, and da 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 da.
Yeah.
So having that because we believe that's going to be the outcome, that the actual outcome is somehow going to reflect our belief, which is one of thousands, if not hundreds of thousands of beliefs, and then we'll make a decision based on that belief. I call that the illusion of predictive value, that our belief has predictive value. And so when we act on that, the entrepreneur will make a big mistake, right? Because they're always going to believe that they know what's going to happen, and that the decision they're going to premise on that knowledge is going to lead them to a good result. But the other thing I find is, even if there is an entrepreneur who somehow can overcome all these biases behaviorally on their own and not have overconfidence interfere with their investing, and they can control all these things, what they don't realize, if they have a family, they're now leaving their family someday, because they're not immortal, even though we all tend to think we might be, with a set of investments that need special attention that the family doesn't have the skill set to do. And they've never really helped the family set up an investment in all of human ingenuity, in stocks broadly, like the S&P, that don't require a lot of help to do really well over time in a really safe way, diversified exposure to all of the great things ahead in terms of innovation. And they don't think that way, because they don't think of so that's another reason why entrepreneurs really ought to take sometimes a step back and say, even if I think I can do a lot of these things, which I can't as an investor, how am I protecting my family?
That's a great way to end. This is such a fascinating. We can carry on talking for forever. It's such a fascinating topic.
Well, I've really enjoyed it, and I appreciate your your questions and the whole approach of the podcast. Really,
Thank you so much, Jonathan. Thank you so much. So, Jonathan, tell us, how can we connect with you? How can we find you on the internet?
So great. So you can go to fusionfamilywealth.com. That's our website, and all of our contact information and a full description of our philosophy and approach is available there.
Wonderful. Now, if you're listening to us on the podcast, then the link that Jonathan just mentioned and his other links will be in the show notes. And if you're watching on YouTube, down below in the description section, we'll have all the links for him to go check him out. And as we discussed on Friday Feature, whether in or out of US, he might be able to help you even if you're out of US. Do reach out to him and his team and see how he can support you with your wealth management. And on that note, thank you so much, Jonathan, for such a fascinating conversation.
Thank you, Gull. It's really a pleasure.
And thank you for listening to me and Jonathan today, talking on and on about wealth management, especially for entrepreneurs. I will be back with another amazing guest on another Money Talkies segment, finding out how you and I can build a better business and a better life. Until the next time, this is Gull signing off. Take care and bye for now.